Bloomberg Audio Studios. Podcasts, radio, news.
Bloomberg's Dani Berger is speaking with Thoma Bravo founder Orlando Bravo at the LAVCA Conference here in New York. Let's listen in.
Orlando, there's so much change happening right now in the industry, but you started your career also at a moment of change. I would love to get into that because you started as a banker at Morgan Stanley. The lore of your career goes is that you're often tried by your managers to pigeonhole you into just LATAM, but here you sit here, the expert in private capital when it comes to software and tech. How did you end up there?
By luck, yes. But Dani, it's a pleasure being here with you. We're friends. We've gotten to work together over the years, and I organized my whole New York week and a half around this conference. It's very special for me to be here, being from a small town in Puerto Rico with all these great investors from Latin America or people that have an interest in Latin America, venture capital in the region. It's really, really special for me. When I started at Morgan Stanley, now I grew up in a small town, Mayagüez, Puerto Rico. For anyone that has been there, probably very few of you have. And through a lot of opportunity and seeing things that I was able to see, I got lucky and was able to get a job in Wall Street. And they put me in the Latin America group in M&A at Morgan Stanley. But next to our group, there was an equally small group. This is in 1992. That was the tech group. And people were, at Morgan Stanley saying, Latin American group is small, this tech group is really small. And for some reason, when we would get together, every week those two groups would get together, I was like, I want to be in that tech group. There was something about it, and I'm not a coder, I'm not an engineer by background, but it seemed to be a business that really fit young people really well, where you could have a lot of responsibility early in your career. So I went to the West Coast, I went to graduate school there. Then the same thing, I couldn't get a job in private equity. There were very few jobs available in the alternatives industry back then. It's grown so much. And at the end, a couple of people gave me an opportunity to be in the Latin America group, but Thoma hired me and said, if you want to do tech, come on in and I'll open up an office in San Francisco. And we started then.
I think it's also important to note, even though you didn't stay with LATAM investing, that you went into tech, but you've always kept close ties to Puerto Rico and continued to do work for the community there.
Big time. I'm actually going to Puerto Rico next week for a foundation event. My experience thus far has been one of opportunity. I'm very self-aware of that. Even when I look at our organization today, Thoma Bravo, we were one of the first to do a software buyout deal during the dot-com bubble collapse. Even though we were one of the first to do tech buyouts, and we were one of the people or one of the groups that created this category that has been very profitable for LPs, and it's the biggest category in buyouts, and will continue to grow and continue to take share. I've never created anything new. I got the opportunity to learn from one of the best investors in the world, Thoma. I got the opportunity to learn from the best operator I'll ever meet, Marcel Bernard, the most important person that has ever worked at our company. During the 70s, he ran different divisions of Motorola. We grabbed both concepts and just applied them to an industry that we really, really liked.
What a time to be doing that, though, helping found Thoma Bravo in 2008, really is the tech bubble, the remnants of it, the financial crisis. It's such a moment in time. How did that help guide you, how you grew Thoma Bravo, and how you think about this market today, especially when so many parallels are being drawn between what's happening in AI at the moment and the tech bubble of the 2000s?
Yeah, and by the way, to end with Puerto Rico, therefore, since I was given so many opportunities, our whole business is based on giving opportunities to existing management, to our people, promoting from within and in Puerto Rico to try to change the opportunity set so the more people participate and have an equal chance. That's kind of what I try to do there. In terms of what happened during the bubble, one important lesson is to focus on the business and the numbers that are right in front of you instead of being too affected by the noise. These are general things that are going on right now. AI is going to be transformative. It's going to be so powerful. It's going to be so exciting. And it's very, very new and very early. So many people are paralyzed now, including LPs, to say, do I touch this area, a services company? Do I touch a software company? Is this going to be disrupted? I just get these inputs all the time of how everything is going to change overnight. It will change significantly, but it will be an evolution. Right after the dot-com bubble burst, I don't know who remembers and who was there around that time, people thought that enterprise software was dead. One article after the other. These stocks traded at $1 and $2 a share. Can you believe that? It's one of the greatest industries, $1.5 trillion economy today. We made a lot of mistakes before that, but we would go to these companies and they would let us look at all their files. We'd say, no, this is a good business. All the customers are renewing, they're buying more. They really need to use these products. So just focusing on the details and the business really helps you do something a little bit different than everybody else.
Well, it's interesting because it's a two-track, and I want to get into software more, but it feels like a two-track. You're describing LPs being frozen on legacy tech or evolving tech, let's call it. And then on the other side, a frenzy around AI and huge valuations that a lot of these private capital or public market companies are getting around AI. Do you look at that and say, we've gone too far?
Look, AI and software go together. That is becoming clearer and clearer. Look at the $250 billion market cap software companies. They have absorbed AI, and now they're selling huge agentic solutions to their customers. We have a portfolio of about $30 billion in revenue. Now, we're private equity, so we can react faster than other forms of governance. All of our companies now have big AI solutions embedded in their products or agentic solutions to close the loop, and now their available markets, or TAM, total available market, has doubled, tripled. It really, really goes together. It's not like this new thing where the corporate enterprise would completely change all of their processes, all of their technology, all of their interdependencies. AI will create new solutions and new use cases, many of which will allow people to use technology more than they were doing before. Look, there's so many solutions today that exist that allow customers to save half of the cost in many items, in supply chain, in many, many, many categories. And right now, society or companies use them 5%, 10%. So it all takes time, but once again, it goes together.
There is, at least you can see in public market, those nerves. Salesforce, Adobe, some of the worst performing stocks, underperforming the S&P, down, I think about 22% year to date. Because of that, and maybe that's a correct way to look at those specific companies, maybe not, has there been a valuation reset in private capital as well? And to what degree does that hurt you, or does it present opportunities?
The chairman said that he's an optimist, and I'm always an optimist. When you own a company, you always have opportunities. Now, you mentioned a couple of stocks, great companies. Now, is their valuations and multiples down because there's some AI threat, or are their multiples down because their growth rate has gone down? We really think it's the latter. Investors buy numbers, they put money out, and they buy numbers. That's what the greatest investors do. The rest is noise, and the market is highly efficient. So I don't think that there's been this re-rating of the sector because of AI, because really smart investors agree that this over time will help these companies that are trusted by the customers, that have proprietary data, that are embedded in their systems. It's helpful. I cannot even begin to describe how helpful it is.
Does it at all, though, put pressure on margins, for example? If you have someone that says, all right, I can find a cheaper solution that's AI-driven, it doesn't take as much, it doesn't cost as much, does the whole industry pricing need to change because of the AI offering?
There's always the question whether software is Econ 101, where price equals marginal cost. You built all these products, but the marginal cost of delivering one is extremely low. So you kind of race to the bottom, and you have to control discounting. The key, and what we try to do, is have the lowest cost of production, have the most efficient company there is. So when we do buy these billion-dollar companies, we are very upfront that the first course of action is we're going to reduce the cost of the business, try to get it to a 40% margin, usually from zero. And if you have the best run company making the right investment decisions, you can invest plenty in AI because you're not wasting a lot of money in other activities or trying activities that the company doesn't even have a core competency in doing.
Well, considering you've done that to so many companies, I'd love to know how you're using AI internally. What about Thoma Bravo's own processes? How are you utilizing AI?
To grab information. It's really, and I think most companies are using it that way, right? We all as consumers use it to ask questions, get quick data, search. Companies as well are using it in that way. We're using it to get information a lot quicker. For example, at the end of the quarter, we love those quarter ends. Now it's October because companies have a January fiscal year end. That's something that SaaS companies did a while ago. But as we come to the end of October, instead of me having to call every single partner across our portfolio of 60 companies, I just know the bookings results. And you kind of can consume that pretty quickly and say, oh, are we in good trends? And that really informs how you invest in companies as well. All your pipeline of deals, is the industry slowing down? Are customers buying more? But the ability to consume information very quickly and data is how we use it.
I talked to one of your competitors who maybe will remain nameless that said that they were experimenting with an AI IC member, that they would feed it all of its information and all the decisions they made. And he'd almost get kind of a vote, or she, I don't think we can gender these things, on the IC. Would you ever do something like that? Would you use it for actual decision making?
That would be pretty cool. I mean, we would, and I've heard some VC firms have done that as well, and this IC member shows up and then has the most power, and how could they possibly be wrong? They have all the data, the super brain. That would be fun to do at some point.
Okay, well, you have to let me know.
The thing is, see, Dani, the thing is, all these things are very helpful right now, but you try to think of your time during the day. I always tell our team, private equity, you have three things to do. Get the money, get the deal, and improve the deal. If in your 18-hour day, if you really want to stretch it that way, 7 days a week trying to crush it and make money for LPs in an ultra-competitive market, you're not spending time on those three, maybe a competitor is going to do better. So you have to be careful how much you're levitating and investing in projects that are intellectually interesting versus actually getting that deal, which, as you know, many practitioners here, is very hard to convince a company that's worth $10 billion to sell it to you, no matter how poorly they're doing. And it's a day-to-day, we do controlled deals only, it's a day-to-day effort to improve the company. The head of sales quits, now you got a problem. The pipeline is low. You have a problem with a competitor. You have to take out the cost. You have to track that company on a monthly basis. For example, we do, instead of quarterly board meetings, given the intensity of our operations, we do monthly operating reviews, 8 a.m. to noon with every single company, all the direct reports in the room. And these processes that is the alpha that our industry looks for. In software, it is incredibly huge. When we started in software, the average software company lost money. Today, and after the industry became this 1.5 trillion, the average publicly traded software company loses money. There has been no operational improvement in the public markets in almost 30 years in the way software companies run. Now, groups like us, we started small. We started producing 25% margin, now 35. Now 40 to 45, because we're also buying better businesses, and we've learned. But that is so intense that it gives you very little time to pursue internal projects.
Well, you mentioned the things that you should be doing if you are in this industry and delivering value to your LPs. One of them, of course, is exiting. And this is an industry that has struggled with that as a whole after maybe overinvesting in 2021 and 2022. You've seen the rise of continuation vehicles, for example, liquidity solutions. And many people would say it's just a way to provide liquidity. It's the creativity of this industry, and it's a natural progression. Other people would say it's a failure, that you didn't get the exits and that you're continuing things on. Where do you stand on it?
Both. It's pretty controversial. LPs have gotten used to it. They've accepted this. I think you should do that as the exception rather than the rule. You can also do so many in your fund. You mentioned valuations. In our world, say you are looking at a 15% growth company that has high quality of revenue, that is a market leader in its space, that is now highly profitable because it's been owned by private equity. Those companies used to trade in the private markets for 20 to 25 times EBITDA. something in that range, from one firm to another. Now the valuations of those companies are 15 times EBITDA. So as a owner, the opportunity is that you can buy other companies add-on acquisitions much cheaper than you had in your model. So you always try to use these things as an owner to your advantage. You then have to create more value so that at 15 to 17 times exit, you can produce the returns that your investors expect. And that's where it comes in, and it's that optimism of there's always something you can do about it. When there was inflation, you had this huge labor inflation in your employee base, but that means you can raise prices to your customers even more because these are productivity tools. Same thing if prices go down. So what happened in private equity, and the reason why I say the industry for a while there lost its way, is one of the reasons is people forgot to sell. Our industry is you get the money, you try to transform a company as best you can, and then you sell that company. There is no permanent hold in our industry. If you want to do that, go to the public markets, form a holding company. Tell your investors, I'm going to hold these things forever, back me, and we'll figure out a way to make money that way. Buy my stock. Private equity is not that. The industry levitated too much. And we always say it's much harder. Remember when I said how hard it is to buy a company? It's much harder to sell it. So our team has to spend more time selling a company than buying a company. And that's something that we do rigorously. And it's something that really helped us. You and I were talking about in Super Return. In the last 18 months, we delivered back to our investors $20 billion in cash. That really helped our firm. Now, it didn't happen overnight. We were working on those deals and on those sales for a while.
So all these evergreen funds that are popping up, sounds like they're a problem then.
It's if you hold a company too long in private equity and in this transformation world that we live in that is not linear, you will ultimately face a big project, especially in software. Because it's not just the technology change or AI or how you have to invest, it's that these companies are exhausting to run. You live quarter over quarter. That's why it's tough for family businesses to hold software companies, right? It's not a thing. You go from one entrepreneur to the other. And it's also a culture of employee ownership, where employees, especially in Silicon Valley, need to have that return and that pop in their options and that restricted stock. So if you hold these things for 20, 30 years, I mean, we would love to. It'll be better for our business. We'll make more money, but it's not the way to really serve your customers as LPs.
Well, as you mentioned, when we had spoken earlier this summer, you were really out front with saying private equity has lost its way. Where do we stand in that cycle now? Every now and then you hear a news report of a company or a fund that tried to fundraise. It doesn't do so as successfully as it has in the past. Where are we out on in the shakeout? Are we about to see some real visible pain between the haves and have-nots?
We are in the middle of the shakeout. It's when you see the few funds that raise all this great amount of money, they have two things. They have great performance and they have liquidity to their LPs. They have high DPIs. The investors in private equity, states, sovereign wealth funds, that's where most of the capital comes from, the big money, 80% of the money. Their boards still believe in private equity. The 10-year performance beats everything, the 15-year performance, the 20-year performance. The challenge is they have an allocation usually to private equity of 15%. Some are growing a little bit from 13, others may be decreasing depending on their portfolios. That investor base or that allocation is very stable, which is really nice for us and for the industry. But that allocation is stable because people get money back and they redeploy the money. If not, that allocation would grow on indefinitely. So when we meet with our own investors, we have a sheet for every one of them. And that's the one piece of paper we have is how much money they've given us, how much money we've given back, and therefore how much money maybe they have left to redeploy. Because also as a manager, they cannot be, we would love to, 100% concentrated in Thoma Bravo by continuing to give us capital. They need manager diversification. So the people that don't have liquidity and are having problems, they're just going to go away. And I've never seen that in the industry in 30 years. The best managers are going to get a lot more money, and we're seeing that also in the business.
What does it look like for funds to just go away? Is it they kind of quietly wind down? Does more consolidation happen? Do you have some really high-profile shakeouts? What exactly does that even look like?
We're seeing a lot of funds wind down and close. We meet with, we have most of our partners are most of the states and most of the sovereign wealth funds. And I spend about 25 to 30% of my time with them to see how our performance matches up to our competitors, to see how they're doing, how else could we help them, are we doing enough co-invest? We are so close to our partners, and they are very open, and they tell us we're really worried about these dormant or zombie funds because they've lost half their team, they've gone to do something else, and their senior people know that they'll wind down the portfolio and that there's no future fundraise. It is still, private equity is still a bit of a momentum business. When you're returning a lot of money, your people have confidence to put money out. Investors have confidence to give you money. People are happier. Everybody that carries worth something to the team. People are getting promoted from within. The older generation didn't lose 10 years of opportunity. It's great. So you see that now, and now that's accelerating because the added pressure is the S&P with the Magnificent Seven in the last 5 years has done great. It's hard to compete with those stocks, and yeah, that's where we are.
So to be clear, the issue isn't just that exits aren't happening, it's that just straight up managers are underperforming public markets.
100%. Over the last 5 years, the average private equity firm and venture capital firm has underperformed the S&P 500. Now, the best of the best always crush it. They find a way. And we're talking about losing its way, there's a lot of experience in this room, but for those of you that are younger in starting a firm or building a firm, private equity should be agnostic as to what the environment is. You're not buying a stock, you're buying a company. It's not what's happening to you. Well, you buy a stock and the stock price goes down and inflation goes up, or this happens, or there's a tariff war or trade. You can only sell the stock or keep it, but things are happening to you. When you own a company, there is so much you can do about it. You just have to adapt to the times.
What do you then make, as this shakeout is happening, that there's a serious and big push into wealth and retail? Some would criticize that and say it's because fundraising has been challenged, that people are looking into other avenues. Is there a bit of that happening in this industry?
Look, it's new. Just like AI or the power of these predictive models is new. How will it evolve? Would it be a good thing for the industry and institutional investors or not? Once again, on those things, since they haven't happened, we don't know. Now, look at what I just said about institutions, that 15%. One of the reasons it's going to grow so much is because allocation by retail and private wealth is close to 0%. So it's going to go up. That's the huge market that is completely untapped, that will be tapped into this alternative asset class. For us, the way we see it is we are going to look at it, but very carefully and very strategically. And the reason we're going to go slowly and strategically into it is that investors, retail investors and high net worth investors, really need to understand what the manager does, how the manager invests. I go back to the point of our business is not linear. We buy $1 billion revenue company that has no earnings. We cut 20% of the cost. We do this. Those projects, even when we get the best outcomes at the end, they weren't a straight line. So with these investors that have liquidity, if they don't understand really well what you're doing, they may make bad choices with your investment over time. Just like I mentioned 30% of my time is with institutions. I really need our partners to know exactly what we're doing, why we're doing it. When we make a mistake, they understand. When we do well, there's a reason why we got lucky or did well. Explaining that to the retail channel is going to be absolutely critical. Think about it, right? We're investing the capital. You want to know who you're dealing with.
For sure. But there are other firms, you can make the argument, they're going full speed ahead. And maybe there's something of a first mover advantage. Do you look at some of the things happening, Apollo having an ETF, others discussing trying to get into 401ks, and worry that maybe you need to get in first?
There's that FOMO, and you have to resist it, especially since there's so much demand for it. If you open the floodgates, there is just incredible demand because it's 0 going to 15, and people want actually, and rightly so, individuals to be part of the economy, and North American economy especially, in tech and software, where you're targeting smaller companies with owners that can really add value to these companies as an alternative, right, to just buying the Magnificent Seven forever, which with forever won't do as great as they've done over the last 5 years.
It's really interesting because there's pressure and other people are thriving. And amid all of that, you had one of the biggest take privates of the year until EA came along with a $55 million.
I know. We thought we were.
Are you upset they knocked you off the throne this year?
Well, I don't know. My partners were like, one of them is ripping his eyebrows out. He didn't understand. I thought it was a good thing because at some point we can't be the only crazy ones doing all these $10 billion deals. I mean, literally,
but they upped you by $55 billion, the biggest LBO in history. Just given some of the stresses we were talking about, is that a one-off, an aberration? Is Thoma Bravo doing a huge deal with Dayforce and Jeppesen? Is that a one-off, or have the mega LBOs returned?
It's look, this is not new for us, right? You mentioned this year, Jeppesen and Dayforce, that were both around 10 billion announced deals. But we did Proofpoint at 11 billion, RealPage at 10 billion, SailPoint at 8 billion, Ping and ForgeRock at 8 billion. I mean, we were just going there because our strategy is to focus on our two core competencies. One is our team really knows how to buy the best. The market leader in these categories of apps, infrastructure, and cyber, the number one player. And it's so important in cyber to buy the number one player. You cannot go in and buy the number 3, 4, 5. I can talk about that all day, why that's the case. And our second team's core competency is turning a great innovator, which those companies are, into actually a great business. Taking that 20% growth of the company and innovation and market leadership and making it work for the shareholder when those companies were delivering 0 cash, have them deliver 40% cash. That way, our investors become fundamental investors in software. Instead of depending on a revenue multiple exit, which is completely arbitrary and completely volatile, they depend on selling the company, or they're selling the company at a 25 PE. Highly justifiable as a small premium to the S&P 500 for 4 times the growth and a much, much better business. All recurring where cash flow is greater than PE. We turn a revenue multiple to an EBITDA multiple. What happened is, as the SaaS industry has really taken off, and it's still at its infancy, 50% of the systems are still on premise, we have this enormous opportunity to take these beautiful companies and transform them that way. Now, we need to keep proving that we can generate the performance at the scale that we're doing. And we've had some wonderful exits in the past at a big scale. So it's nice to see somebody do a $55 billion deal, because now we can tell our investors we're middle market. And we do middle market only, and we're really targeted, and these things are really small. We're like, you see, we told you, these companies are, yeah.
Only about a minute left, Orlando, and I know you've touched on this in different places, but it might be nice to just put it together for everyone watching and for trying to navigate a particularly difficult time in private equity and private capital investing. What are just the most important principles to be concentrating on at this time?
Focus on the business. Focus on your investors, but really spend most of your time cold calling all the companies. Really focus on the business. Get away from what's the firm going to be in 10 years or 20 years, what's the strategy, what's my org structure. Mentor your people to get the deal, and then figure out a way, a repeatable process that you can continuously improve the company. Have your feet on the ground and focus on the business that's right in front of you. Do the work, do the diligence. It is so important, and don't be as affected by what everybody thinks. The answers are sometimes so obvious, investing-wise and operating, that you just need to go to the source and focus on it. Our group has become much larger. Now we have $180 billion under management. We work as hard as possible to run it, just like when we did our first deal at $50 million. And frankly, the problems that our companies have and the opportunities that our companies have and how we generate a deal and convince a founder or a big company to work with us is the same as it was before. So remaining true to that is very, very important.
That's the perfect note to end it on. Orlando, thank you so much for joining this morning. And thank you all for watching. Please join me in thanking Orlando Bravo. Thoma Bravo.
Thank you. Thank you.